Let's get across the market open now. Jimmy Jang joining us from GBA Capital. Jimmy, welcome to Tuesday. Let's begin on Wall Street. Very strong session we saw there, particularly those hyperscalers doing very well. What are your observations of the market there?
Morning, Andrew. You're spot on. I think there's obviously big market confidence coming back in the US now, especially after that block trade was done by Citadel, with the awareness group, the fund that obviously collapsed due to their leverage exposure. So I think the market is now really slowly looking into, repositioning all those, harsh sold off stocks. So a lot of the AI stocks have obviously done really well. Chip makers have recovered, but we're still kind of, mainly looking at what's happening in Korea because obviously, main two companies, Samsung and SK Hynix, still takes up a big portion of the index over there, and that flows through into what the US potentially might do as well. So Korea session still wasn't as great as what we anticipated yesterday, and that's still seeing some strong selling pressure. And at the moment, with obviously what's going on between US and Iran changing their plans every day, it brings a lot of uncertainties at the moment. So it's a lot of things to look out for today.
Jimmy, what do you make of that news flow, particularly out of the White House in regards to what's going on in the Middle East? Because it's rinse and repeat at the moment, isn't it?
That's right, and a lot of risk equities like semiconductors and AI stocks, for example, which have already been a lot of talks on Wall Street. It's very overpriced, and it's almost like they're going to be the next dot-com bubble that we're seeing. And on top of that, if we see this kind of on and off in the war, it's just not helpful. So this is one of the reasons why we saw the government bond yields just continuously increasing because obviously with the higher energy costs, the market's definitely pricing in a rate hike by end of the year. And obviously that pushes the yield and puts more pressure on the equity. So what's really interesting is we actually really like gold at this stage. This gold traditionally was a safe haven. It's something that it's been really overlooked, for over the last few years. A lot of the people bought gold as more of like a growth commodity when it shouldn't be. And when the gold is running, it's not really good for the economy. But when there's an uncertainties in the market, gold should be running. So gold I think, is at a really good price range to rebound and have this all the growth capital, gains, reallocated into stocks like gold. And we saw stable coins, for example, in US Tether buying, dramatically amazing amount of gold as well as a reserve. So it's something that really investors should be looking out for as well.
How are you playing gold then, Jimmy?
Look, at the moment, with the higher energy costs, it is quite difficult to really, recommend gold explorers or developers at this stage, just because if we see any uncertainties, like what you mentioned, Andrew, any changes in what's happening in the Middle East, that also puts a lot of pressure to the actual, performance of the junior explorers and developers, or even producers for that matter. We saw, a lot of the producers getting harsh sold off as well. So when we're bullish on a commodity, well, I'd rather just go long on the actual commodity price. So at the moment, we took a structured product to take an exposure to the gold price directly, and that's kind of eliminates all the other concerns and volatility that we might not expect on top of the current volatility that we're seeing at the moment. So the last thing we want on top of this macro uncertainty is probably first of all, the management risk as well.
Now, Jimmy, of course, reporting season is just getting underway here in Australia. This morning, in fact, we've had Credit Corp out with its results. Have you had a chance to take a look at that?
Yeah, look, at the moment, I think one of the results that we're seeing right now in Australia, there's obviously a big portions of, volatility. We're also going through the reporting season in the US as well. So for example, Credit Corp Group also posted a pretty strong increase in profit, but close to 12% in 12 months to June 30. So that recovery outlook has also told the share market this morning that their net profit is also increased about $105.5 billion as well. So that was a record when the company released the report this morning. So I think the main thing is it was kind of fueled by the surge on their US debt business. So, which obviously, earnings jumped about 57% at the moment, and that kind of also shows the uncertainties that the economy is also presenting as well. So, when the market goes like this, it's almost certainty that we're going to see a higher debt rise, and the group's overall revenue increased about 7.4%, which is something that's really strong to see to about 585 million. So that obviously, also declared a final ordinary dividend of 45.5 cents per share, which is fully franked as well. So for those people that's looking for more steady growth and at the same time certainties in this kind of market, Credit Corp should be a good pick.
Jimmy, more broadly, what are your expectations for reporting season here?
Look at the moment in the US, for example, we're seeing some strong earnings and growth. But what the market in general, and whether it's in the US and Australia at the moment, I think it's mainly the margin. So, we saw such a strong growth of stocks over the last 2 years based on the growth outlook of the company. But now, because of the uncertainties, the investors are actually looking at the margin. So the profit margins of each company is actually more important. And most importantly, how much cash do they have and the cash flow that they have on every quarter. So that's also being very strong look for in the US. So a lot of the software companies, AI companies, for example, resulted a very strong growth on their revenue and the forecast, but the market didn't see that as a positive thing. They also just more looked at the margin. So if your capex is getting higher and higher due to these uncertainties, the market won't like it, especially in this market. So it's probably the margins and the cash flow and the cash earnings is probably the where a lot of people should be focusing on rather than growth at the moment.
Are there any particular stocks you perhaps think could potentially surprise the upside? Conversely, I guess, any that you're a little worried about?
Yeah, well, I think the main thing that we really liked was Megaport. Megaport was doing a cap rate. MP1 is a ticket code. Megaport has been a favorite stock for a lot of the investors, and more so recently as well. So they have a fantastic earnings, and they did a really strong cap raise just about 3 to 4 months ago. And they're stacked up with cash, and especially with the outlook that the US is going at the moment, Megaport could really take advantage of it right now. One of the things that might be really concerning as a whole, maybe not so company focus, is any company with low cash balance. I think that's the first thing that people should look at, because if companies need to do a capital raise right now in this kind of market, it's almost certain that they need to give up a lot of shares as a discount, and that puts a more selling pressure on top of what was going on at the moment. So, like I said, if the company has less than 3/4 worth of funding available, it's probably best to just hold at the moment rather than just jumping in a gun very quickly, because if they need to do a cap raise and we see a bit more harsh, environment in the US market, then that also puts a lot of pressure on the selling price. So probably worthwhile to just wait at the moment, because a lot of the stocks are on a discount. So it's much more we can be prudent right now rather than trying to go FOMO at the moment.